So good morning, bonjour, and welcome in Paris for all of you. I said to Dan that I really admired the timing of the GEC conference, because to start so early on a Monday morning is really impressive, and I want also to welcome your courage to all of you, because it was not that easy. Je pense en particulier aux Français qui sortent d'une grande semaine à Pont, et recommencer le lundi matin à 8h30 n'allait pas de soi, mais bienvenue encore plus à la Banque de France. Sorry for these words in French, but it was a very private joke. Do you understand French, Loretta? So our last GEC conference here in Paris, dear Michael, was 2 years ago, in March 16, and so many things happened in these last 2 years. It's almost a new world. And Don explained to me that this early schedule is intended to be, I quote you, ahead of the world, so it's very welcome, because there were dramatic changes, obviously, in the geopolitical environment, including last week. I don't need to elaborate. Also in the economic field, and positive developments with the clear upswing in all advanced economy and emerging markets economy. And they had consequences in our central banking and monetary field. We saw a clear progress towards a gradual normalizations on both sides of the Atlantic, but especially, to be fair, on the other side of the Atlantic. So our work together is very welcome to try to give some lights on this new world. You will probably don't elaborate a bit more about the program, but after the two keynote speeches by myself and Loretta, we will try to give lights in 4 sessions from research, policy, markets, and the economists themselves. So I don't want to be longer. I wish you an excellent conference, an excellent day in Paris, and then I give you the floor to introduce. Merci beaucoup.
Thank you, Governor. We are very happy to be here. This is GIC's 10th event in Paris, so we feel we have hit a bit of a milestone, and it is with the help of everyone here that we are able to do that. I'd like to thank in particular Chris Whalen and Paul Horn on the GIC side for their assistance with this program. GIC was started in 1976 after there was a celebration of American independence for the 200th anniversary of our country. And there was a group in Philadelphia during that time that thought it was worthwhile not to think just about independence, but about interdependence. And given that our last conference here was 2 years ago, and given the number of things that have changed over the past 2 years, we feel it is especially important to emphasize that theme of interdependence that has become so critical. So here we are, and there are a number of things to worry about. There are plenty of things to worry about in the global economy. There's currency volatility in emerging markets recently. Emerging market spreads have widened. There are trade tensions. Producer prices in China are rolling over. There are concerns about corporate earnings. There are valuation concerns in the financial markets. There's talk of whether tax reform in the U.S. will work or not. There's some cooling European data as of the first quarter. There's global debt issues. We have a midterm election coming up in the United States. We have data like purchasing managers' indices that are rolling over. We have LIBOR rising. We have the yield curve flattening. We have higher oil prices that'll impact consumers. We have the issues with the Iran deal and what's going on with the White House. We have populism that is still present, whether in Europe or abroad. And so today's conference is meant to address a number of these issues and to try to leave you with some information and some things to think about. It's meant to start the conversation, not finish it. So what GIC prides itself on is being a neutral convener of dialogue and allowing that to continue. So we're going to start out with some central bankers' outlooks. We're then going to go into some sessions on economics, in particular with the international environment. We'll look at the policy environment shortly thereafter, and then in the afternoon, we will consider the financial market outlook as well as the general economic environment. So thank you all for being here, and I look forward to hearing what the governor has to say to start us off. Thank you.
So, ladies and gentlemen, dear friends, it has been almost 4 years now since the Eurosystem incorporated several new instruments to combat the deflation risks that threaten the euro area in the wake of the crisis. And one of our important tools was our asset purchase program, also referred to as APP, the euro area version of quantitative easing. It was announced in its full-blown version in January 2015. Looking ahead, our net asset purchases will stop when we see a sustained adjustment in the path of inflation, what we call SAPI. We are not there yet, but we are more and more confident that the three criteria of this SAPI, namely convergence, confidence, and resilience, will be met. So the time when our net asset purchases will end is approaching. And as I already said, whether it will be in September or in December is not a deep existential question. Today is thus a good time to reflect on our experience with the non-standard measures. I would like to share with you this morning some views on the following three questions. First, how effective were these non-standard instruments as a whole? Second, how much did the asset purchase program itself contribute to our exceptionally accommodative stance? And third, and finally, how can central banks manage the risks they face when making their way to the new normal and exiting from such policy packages? Needless to say, in all these issues, we benefit from the US experience, in particular of the Federal Reserve, which has achieved in recent years a smooth path to normalization. We are fortunate to have Loretta Mester, President and CEO of the Federal Reserve Bank of Cleveland, with us this morning. And Loretta, I will give you the floor in some minutes to share your thoughts. But let me come to my first question. Where do we stand on our unconventional tools as a whole? Since 2014, we have been playing what I like to call a quartet of non-standard instruments. Our first non-standard instrument is the APP itself. I will be more specific in a short while on the channels through which this program operates, through stocks and flows. The size of our asset holdings related to APP is now approaching 2.37 trillion euros and should reach 2.55 trillion euros by the end of September. Our second instrument is the negative deposit facility rate. Its purpose is to relax the zero lower bound constraint, therefore lowering the level of the yield curve. Our third non-standard instrument in the quartet consists in providing forward guidance on the path of future interest rates to make future monetary policy decisions predictable and to signal that rates will stay low for an extended period of time. This has contributed to flattening the short to medium term of the yield curve. The fourth and last instrument, sometimes forgotten, is the provision of liquidity and credit to banks. Most recently, the second series of targeted longer-term refinancing operations, the so-called TLTRO2, was launched in 2016. We are currently lending about 760 billion euro through this instrument, which eases credit conditions for firms and households. These four instruments, this quartet, is complementary and self-reinforcing. As a consequence, monetary policy measures have been supporting aggregate demand as well as employment, and the recent economic recovery in the euro area. The Banque de France just released this morning its first preliminary forecast for French GDP growth for Q2 at 0.3%. But this somewhat softer pace could be influenced by the exceptional holiday schedule in May. At this stage, new orders remain positively oriented and do not point to a trend change. Compared with the beginning of 2014, 7 million jobs have been created in the euro area in 4 years. We estimate that without monetary policy measures taken between 2014 and 2018, economic growth in the euro area would have been 1.9 percentage points lower in cumulative terms over the 2016-20 period. And for inflation, this is a figure for growth on the left part, but for inflation on the right part, the cumulative effect is estimated also to be 1.9%. On the inflation front, precisely, annual HICP growth was 1.5% in 2017 and is expected to rise to 1.7% in 2020. Underlying inflation is set to strengthen, irrespective of short-run fluctuations in energy inflation. We clearly see the current slowdown, the 1.2% flash HICP estimate for April, with a particularly low figure in Italy. We see this current slowdown as temporary, and we expect inflation to resume its progress in the coming months. I now come to my second question, trying to give a comprehensive view on the APP itself. In theory, the effect of assets purchase program on yields is not straightforward. As Ben Bernanke said in a famous statement in 2014, I quote, "The problem with QE is that it works in practice, but it doesn't work in theory." But today, 4 years later, we probably better understand the channels through which this policy works, now that it has been implemented by all major central banks. We can distinguish, according to me, three main channels through which our APP operates. A portfolio rebalancing effect through duration extraction, a signaling effect, and a re-anchoring of inflation expectations. Let me start with the portfolio rebalancing channel and the duration extraction. By purchasing long-term assets, central banks replace long-term maturity and riskier assets with short-term maturity and safer assets for investors. Investors consider duration risks as a source of possible losses, and they require an additional compensation, the term premium, for bearing such risks. By reducing duration risks for assets held by investors, the APP weighs on term premia and consequently on long-term yields. According to our estimations, holding a stock of assets equivalent to 10% of GDP lowers 10-year bond yields by about 45 basis points. This estimation implies that our APP in the euro area, with more than 20% of GDP, has contributed to lower long-term yields by about 100 basis points. There is a broad consensus around these estimates for the euro area, as well as for the United States and for the United Kingdom. Beyond extracting duration risk, the portfolio channel of APP also works through the exchange rate. Rebalancing flows might result in increased demand for foreign assets by domestic residents and/or a repatriation of funds by non-residents. The second important channel is that APP has had a clear signaling effect on the future path of short-term interest rates. APP has served as a credible commitment to keeping interest rates low for a long time, reinforcing our forward guidance policy. Recent Eurosystem research has shown that communication surrounding the APP has been key for the predictability of our monetary policy. As a result, markets were able to better understand our policy reaction function, leading to a reduction in uncertainty and unintended volatility, and consequently, reduction of risk premia on long-term yields. This effect is even more significant when the size of monthly purchases has been clearly indicated. APP has finally, as we know, provided state contingents to our forward guidance. The third transmission channel of APP comes from the re-anchoring of long-term inflation expectations. When deflationary risks are rising, in particular when the central bank is thought to be close to its effective lower bound, monetary policy based only on interest rates become ineffective. In that case, implementing APP reassures private agents on the central bank's ability to fulfill its inflation mandate. Long-term inflation expectations from survey data bounced back after the APP announcement in January 2015, you can see it on the slide, putting an end to the downward trend observed since 2012. Beyond these three channels, a positive byproduct of the APP has been to contribute to a further reduction in fragmentation risks in the euro area after 2014. By purchasing long-term sovereign bonds, the APP has helped to reduce risks of speculative attacks on sovereign bonds that were not justified by economic fundamentals. Doing so, the APP has improved the financial soundness of credit institutions, especially in periphery countries. Overall, by reducing fragmentation risk on bond yields, the APP has improved monetary policy transmission. But let me be crystal clear. Reducing unwarranted fragmentation does not mean that the ECB is subject to any kind of fiscal dominance. Nobody should expect us to delay warranted monetary policy normalization in order to accommodate debt problems of any member state. While the APP had clear benefits, some have argued that our prolonged accommodative monetary policy may have had detrimental side effects on financial stability. The main potential risks come from high levels of debt, private and public, which would become more difficult to sustain with higher interest rates. I partly share these concerns, and I think we need a better understanding of the side effects of QE. However, up to now, we have not seen any general sign, I stress general, we have not seen any general sign of build-ups of excessive leverage or asset price bubbles in the euro area. Also, vigilance is in order in some particular segments, such as high-yield corporate bonds or some prime commercial real estate. But since the crisis, we have made a lot of progress in addressing vulnerabilities in financial stability, in particular through stronger capital and liquidity requirements on banks, and progress in designing better macroprudential policies. Still, we also need broader liquidity stress tests and macroprudential tools for non-bank finance. And here you can read the last financial stability review published by the Banque de France 2 weeks ago about non-bank finance. We discuss the question of macroprudential tools for such non-banks credit. That being said, I think that an important question ahead is how to better take into account our new financial stability mandate along with our core price stability mandate in our monetary policy decisions. I come to my third and last question about managing the exit. I would like to conclude my remarks with a short discussion of how we should handle a few important challenges on our path of gradual normalization. Let me start with 2 clarifications and then touch upon one broader open question. The first clarification is that APP will continue to shape our monetary stance even if we stop our net asset purchases. As we have learned, stocks do matter. So that the end of our net asset purchases, the flows, will not mean the end of the APP. The Governing Council is committed to reinvesting principal payments from maturing securities for an extended period of time after the end of our net purchases, and in any case, for as long as necessary. The recurrent and sizable purchases induced by the policy of reinvesting maturing assets will continue to extract duration risk from the market, to signal relatively low interest rates, and to favor the anchoring of long-term inflation expectations. The second clarification is that with the end of our net asset purchases approaching, our stance will rely more on our forward guidance on interest rates. Without doubt, our communication will be adjusted, given that the current guidance on policy rates is explicitly conditioned on the end of net asset purchases. As far as the first rate hike is concerned, we could give additional guidance on its timing, well past meaning at least some quarters, but not years, and additional guidance on its contingency on the inflation outlook. Beyond that, the updated formulation of our communication will have to continue providing guidance on future interest rate movements over a relevant horizon, in order to avoid unintended volatility of the yield curve, especially during the transition period. Now, looking broadly over a longer horizon, I believe we will also need a better understanding of the key features defining normal times in the post-crisis economic environment. This need was forcefully recalled by ECB Vice President Vitor Constancio in a recent speech. If, I stress the if the real natural rate of interest were to be lower for a longer period due to structural factors like the savings glut, one should expect the nominal interest rates to hit the effective lower bound more often in the future. Active balance sheet policies should then, de facto, be included in our normal time monetary policy toolkit. This could imply that we keep operating under a large balance sheet and excess liquidity. While the size of the balance sheet will definitely decline as a share of nominal GDP, we still do not know for sure what its new normal level will be. Alternatively, or additionally, there is currently an academic debate about whether or not the quantitative definition of price stability should be revised. Loretta Mester has recently contributed to this debate in the United States. But for the euro area, I would seek to the greatest caution. Changing the inflation objectives, either by increasing or lowering them, would blur the credibility of our commitment to price stability. But let me come back to conclude to my core message about the APP. In the euro area, our current operational framework and policy strategy have proven to be flexible enough to deliver on price stability, even in extreme conditions like the ones we have experienced over recent years. And this can give us confidence, notwithstanding patience and prudence. Confidence about the exit and the new normal whenever they come. Thank you for your attention.
Next, we're pleased to welcome President Loretta Mester, CEO of the Federal Reserve Bank of Cleveland. She regularly participates in the FOMC votes on monetary policy, as well as overseeing 950 employees in Cleveland, Cincinnati, and Pittsburgh. She has spent time at the Federal Reserve Bank of Philadelphia, as well as being a fellow at Wharton, and with several degrees from Princeton and Columbia. Please welcome Dr. Mester.
Thank you very, very much. I really appreciate being here. I want to thank Don and the GIC for inviting me again to speak, and the Banque and François for hosting us today and for his important remarks. I always learn a lot from the GIC's Central Banking series of conferences, and I'm very proud that I have a long association with the GIC. So 3 years ago when I spoke here, I reviewed the tools that monetary policymakers had put in place to address the financial crisis and Great Recession. So I really was interested in what François had to say about the experience here in Europe. And I discussed the Federal Reserve's plans for normalizing policy and some of the challenges we would face as we transition from extraordinary economic and policy times back to ordinary times. Today, the environment has changed, but policymakers, as always, continue to face challenges in determining the most effective policies within the environment. So today, I'm going to carry on the theme and talk about current and future issues that the Federal Reserve policymakers will face as we set appropriate monetary policy. And of course, my remarks will reflect my own views and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee, the monetary policy making body within the Fed, of course. So the U.S. economy is performing very well, and I expect that to continue. Over this year and next, I expect above-trend output growth, continued strength in labor markets, and firming inflation. And I believe the U.S. economy is slightly beyond maximum employment from the standpoint of the cyclical conditions monetary policy can address. And then inflation will reach our symmetric 2% goal on a sustainable basis over the next 1 to 2 years. The outlook is based on favorable underlying fundamentals, and these include accommodative monetary and fiscal policies, healthy household balance sheets, rising personal income, a global economy that's improving overall, and stable inflation expectations. Now, of course, as with any forecast, there are risks around the outlook. Financial market volatility has risen from very low levels of recent years. But so far, investors seem to be taking it in stride, and firms tell us the volatility has not thwarted their spending plans. The rise in oil prices and increase in the value of the dollar are worth watching. Geopolitical risks have risen, and there's uncertainty around trade, which may not be resolved soon. Assessing the impact of trade developments on the U.S. macroeconomy will ultimately depend on the actions actually taken by the U.S. and its trading partners. But in the meantime, continued uncertainty may also cause businesses and investors to reevaluate their outlook for the U.S. economy and alter their spending in the near term. And we're going to need to monitor the trade situation. On the upside, the tax package and increased federal spending in the U.S. are expected to add to an already healthy level of spending in the second half of this year and next year, but the magnitudes and exact timing are still somewhat uncertain. Now, despite the risks, this is one of the most favorable outlooks we've had in a long time. So one might ask, so what are the challenges? The task before monetary policy makers is to calibrate policy to this healthy outlook to meet and maintain our dual mandate goals of maximum employment and price stability. Now, at its meeting earlier this month, the FOMC decided to maintain the target range for the Fed funds rate at 1.5% to 1.75%. And this was consistent with the strategy the FOMC has followed as progress has been made on our monetary policy goals, namely to gradually remove the high level of accommodation that was needed to address the Great Recession. Also at the May meeting, the FOMC continued to implement its plan initiated last October to normalize the Fed's balance sheet in terms of the size and composition of assets. The balance sheet grew in size and lengthened in maturity during the Great Recession when the Fed undertook several programs to purchase longer-term assets in order to put further downward pressure on longer-term interest rates. We're now allowing maturing longer-term assets to roll off the balance sheet in a gradual and predictable way, and this process will take several years to complete. Now, the economy is dynamic, so calibrating monetary policy to the medium-run outlook involves several moving parts. Essentially, the challenge from policymakers is to assess current and future performance on our policy goals of maximum employment and price stability, and to assess the current and appropriate future stance on monetary policy. So let me discuss each of these in turn. The U.S. labor market is strong. The unemployment rate at 3.9% is below its lowest point during the last expansion and near its lowest point in the past 40 years. I expect this unemployment rate to fall further this year and to remain below 4% next year. This year, payroll job growth has strengthened to an average of 200,000 jobs per month. And this is well above most economists' estimates of trend job growth, which lie in the range of 75,000 to 120,000 jobs per month. Now, the trend estimate depends on what one assumes about labor force participation. And this is a key factor in determining whether the economy is at or beyond the level of employment that's sustainable over the longer run. Based on demographic factors, including the aging of the U.S. population, the longer-run trend in participation is downward sloping. But the labor force participation rate has been fairly stable over the past 2 years, a sign of strength in the labor market. We're increasingly hearing from a wide variety of businesses and job placement firms that it's hard to find workers for both higher skill and lower skill occupations, and firms are responding to labor shortages by raising wages. The acceleration in the employment cost index over the past 2 years suggests that the anecdotal reports of firms raising wages to attract and retain workers are now filtering through to the official statistics. An issue for policymakers is that it's difficult to know with precision how tight labor markets are. The acceleration in compensation growth from under 2% earlier in the expansion to about 2.75% more recently is not as strong as one might normally expect from tight labor markets. In my view, part of the reason for this is the low level of productivity growth over the expansion. Over the longer run, wages, adjusted for inflation, tend to reflect the marginal product of workers. During this expansion, labor productivity growth has been on the order of only 1%. Now, this is less than half the pace over the prior two expansions. Research from the Cleveland Fed staff suggests that nominal wage growth over the expansion is not a puzzle if you account for productivity growth, labor market conditions, and inflation. Nonetheless, economists and policymakers have to take on board all the data when assessing where the economy is relative to goal. The movements in labor force participation, combined with the fact that wage and price inflation have remained moderate even as labor markets have strengthened, suggests that labor market conditions may not be as tight as we originally assumed. As the expansion has played out, FOMC policymakers have lowered their estimates of the longer-run level of unemployment. Now, these estimates come with a considerable amount of uncertainty. 5 years ago, in the March 2013 Summary of Economic Projections, the central tendency of projections of the longer-run unemployment rate ranged from 5.2 to 6.0%. In projections this March, the central tendency was 4.3 to 4.7%, down a percentage point or more, with a median projection of 4.5%. And I've also moved down my own estimate of the longer run unemployment rate over time to 4.5%. Now, despite the lower estimates of the longer run unemployment rate, in my view, if one combines all the indicators, labor markets do appear to be slightly beyond maximum employment, and the outlook suggests that labor markets will continue to be tight over the next couple of years. In the past, when labor markets have moved too far beyond maximum employment, with the unemployment rate moving substantially below estimates of its longer-run level for some time, the economy overheated, inflation rose, and the economy ended up in a recession. Achieving a soft landing is difficult, and recent research by Cleveland Fed staff suggests that a strategy to overheat the economy in an attempt to pull more people back into the workforce is unlikely to have a lasting effect on labor force participation. An interesting paper by economists at Stanford University and the University of Chicago suggests that overly tight labor markets can result in firms having to meet rising demand by hiring workers into jobs that are not the best match to their skill sets. The longer this need to hire lower productivity workers continues, the larger the decline in employment when the inevitable bad shock and downturn comes. All this suggests that policymakers have to continue to assess labor market conditions and to balance progress on this goal with progress on our other objective, price stability. The FOMC has set a symmetric longer-run goal of 2% inflation as measured by the year-over-year change in the price index for personal consumption expenditures, that is PCE inflation. The FOMC aims for inflation to be 2% because it believes that this rate is most consistent over the longer run with our statutory mandate. The goal is symmetric, meaning that the FOMC would be concerned if inflation were running persistently above or persistently below this goal, and such persistent deviations would warrant a policy response. Inflation measures can vary from month to month due to idiosyncratic factors and in response to temporary economic and financial disturbances. So when we assess where inflation is relative to our goal, it's important to look through transitory movements and focus on where inflation is going on a sustainable basis. Our goal is expressed in terms of total PCE inflation, but policymakers also look at a variety of other measures of inflation to get a sense of the underlying inflation trend. These include CPI measures, core measures of PCE and CPI, which exclude food and energy prices because they tend to be volatile, and the trim mean and median measures, which drop those components with the largest and smallest changes. We also use various models to forecast inflation. The models include components to account for current and past inflation, utilization rates of labor and capital, and inflation expectations. Now, as good as our various models are, it's important to remember that a significant portion of the variation in inflation rates comes from idiosyncratic factors that can't be forecasted. So forecasts of inflation, like those of longer-run unemployment, have wide error bands. For example, based on historical forecast errors over the past 20 years, the 70% confidence range for forecasts of PCE inflation 1 to 2 years ahead is around plus or minus 1 percentage point. Now, inflation has been running under the 2% goal for much of the expansion, but it's been firming and is now near our goal. Measured year over year, in March, total PCE inflation rose to 2%, and core PCE inflation rose to 1.9%. These are welcome developments, but it's still too soon to say that we have met our inflation goal on a sustained basis. Near-term monthly readings of inflation have risen, but some of the pickup reflects higher commodity prices, and some of the strength is likely to be temporary as low readings from last March drop out of the calculations. I expect to see month-to-month variation in the numbers around an underlying upward trend in inflation as inflation moves to our goal on a sustainable basis over the next year or so. One of the challenges for monetary policymakers will be to keep the public and market participants focused on the median run outlook for inflation, even as higher monthly readings in the near term are followed by some softer readings. We don't want inflation expectations to react to these temporary movements, and policymakers can best avoid that by continuing to convey through policy decisions and communications that we're committed to achieving our dual mandate goals. Consistent with the FOMC's longer-run monetary policy strategy, I'm comfortable looking through transitory movements in inflation, those to the low side and those to the high side, as we aim for inflation over the longer run to be at our symmetric 2% objective, allowing for the normal variation measured inflation. Now, as the FOMC said in its May statement, the stance of monetary policy remains accommodative. Currently, one indicator that policy is accommodative is that the Fed funds rate adjusted for inflation is negative even though the economic outlook is strong. Another indicator is that many monetary policy rules are pointing to higher interest rates given the outlook. For example, the simple monetary policy rules across several forecasts that are available on the Cleveland Fed's external website indicate that policy rates should be rising given the forecast, with the median path somewhat steeper in the near term than the median funds rate path in the March Summary of Economic Projections. In its May statement, the FOMC also said it expects economic conditions will evolve in a manner that will warrant further gradual increases in the Fed funds rate. In my view, the median run outlook supports the continued gradual removal of policy accommodation. It does seem to be the best strategy for balancing the risks to both of our policy goals and avoiding a buildup of financial stability risks. We want to give inflation time to move back to goal, and I don't expect inflation to pick up sharply. This argues against a steep path. At the same time, the economy is slightly beyond maximum employment, and financial conditions are accommodative. In my view, it's appropriate to continue to remove some of the monetary policy accommodation to ensure that we avoid a buildup in risk to macroeconomic stability that could arise if the economy were allowed to overheat, or a buildup of financial imbalances or risks to the financial stability that could arise from the extended period of very low interest rates. Of course, the path policy actually takes will depend on how the economy actually evolves. If the upside risks to growth come to pass, we may need to steepen the path a bit. If inflation surprises on the downside, we may need to go a bit slower. But the gradual upward path is consistent with the modal economic outlook at this time. Now, as we continue to move rates up, we will have to continue to assess whether monetary policy is accommodative, neutral, or restrictive. Essentially, it requires assessing where the policy rate is relative to the level of the short-run interest rate that represents neutral monetary policy. That is the equilibrium interest rate. This equilibrium interest rate will vary with economic conditions that affect the demand for investment and the supply of savings. There are wide error bands around estimates of this rate, and the rate over a short-run horizon can differ from that over a longer horizon. For example, as the economy deteriorated during the financial crisis and Great Recession, the short-run equilibrium interest rate fell to a level below what would be expected to prevail over the longer run. Now, with fiscal policy turning from restrictive to stimulative, the economy growing above trend, and investment rising, the short-term equilibrium interest rate is rising too. As the expansion continues, it could be that in order to maintain our policy goals, we may need to move the Fed funds rate for a time a bit above the level of the funds rate that is expected to prevail over the longer run. Indeed, the March Summary of Economic Projections indicates that the median appropriate policy path has the Fed funds rate in 2020 moving a bit above the estimate of its longer run level, which is about 3%. Of course, 2020 is a long time away, and the policy path actually followed will be responsive to changes in the outlook. Now, in terms of that estimate of the longer-run Fed funds rate, one needs to consider what policy rate is consistent with maximum employment and stable inflation over the longer run. There is reason to believe that this equilibrium rate is lower now than it used to be. In fact, FOMC participants have been lowering their estimates of the longer-run Fed funds rate over time. For example, in March 2014, the median estimate was 4%. Now it's about 3%. The equilibrium rate is related to the longer-run potential growth rate of the economy, which itself depends on the growth of the labor force and the growth of productivity, a measure of how effectively the economy combines labor and capital to create output. Based on demographics, U.S. labor force growth is projected to be considerably slower than it's been in recent decades. While some of the slow growth in labor productivity during the expansion has been cyclical, more persistent structural factors may also be at play. The combination of slow labor force growth and slow productivity growth suggests that the potential growth rate of the economy will be lower than it was in the past. My own estimate of output growth over the longer run is 2%, which is a lot slower than the 3 to 3.5% rate seen over the 80s and 90s. And my own estimate of the longer run nominal Fed funds rate is 3% or 1% in real terms. Of course, policy changes outside the realm of monetary policy could foster higher productivity growth and labor force growth and ultimately support higher potential output growth and equilibrium interest rates. But such policies need to be implemented as the country puts its longer-run fiscal situation on a sustainable path. Recently released projections by the Congressional Budget Office indicate that under current policy, the U.S. federal deficit as a share of GDP will be considerably higher 10 years from now, with rising government debt levels implying that a higher share of government spending will go to interest payments. This would tend to crowd out productive investments by the private sector and the government, thereby lowering productivity and longer-run growth. So let me conclude by touching on two future monetary policy considerations: the operating framework that the FOMC uses to ensure that its policy rate is being maintained at the appropriate level, and the monetary policy framework that the FOMC uses to determine what that appropriate level of the policy rate is. Now, before the financial crisis, the FOMC kept the supply of bank reserves scarce. The FOMC could make small changes in that supply by buying or selling short-term treasuries, and this allowed the FOMC to ensure that the Fed funds rate was maintained at the FOMC's target. But now, as a result of the Fed's large-scale asset purchases, reserves are very abundant. Indeed, banks are holding a bit more than $2 trillion in reserves and accounts at the Fed, and almost all of this is in excess of what is required by regulation. At these levels, small changes in the supply of reserves have little effect on the Fed funds rate. Instead, the Fed brings the Fed funds rate into its target range by adjusting the rate it pays on excess reserves and by using overnight reverse repurchase agreements, which help put a floor on the Fed funds rate. As normalization of the balance sheet progresses, the FOMC will need to decide which operating framework it will use going forward. The Fed funds rate market has changed considerably since the financial crisis, and part of the consideration will be whether the Fed funds rate will remain the best indicator of the general level of short-run interest rates. Another issue for the FOMC is the strategic framework it uses to determine appropriate monetary policy. Currently, we use a flexible inflation targeting framework, which has served the FOMC well in effectively promoting our policy goals. But as the economy moves back to normal, it seems an opportune time for the FOMC to undertake a study of its framework. As a matter of good governance, a central bank should periodically review its assumptions, methods, and models. Moreover, if the longer-term equilibrium interest rate does remain lower than in the past decades, and I also emphasize the if there will be less room for monetary policy to cushion against a negative economic shock. Policy would likely hit the zero lower bound more often, and non-traditional monetary policy tools would have to be used more often. To the extent that these tools are less effective or are constrained from being used, the potential is for longer recessions and longer bouts of low inflation. Given this potential scenario, now is the time to assess whether changes to our current framework could make monetary policy more effective in achieving our goals. Research has suggested several alternative frameworks, such as targeting an inflation rate higher than 2%, moving to an inflation targeting range instead of a point goal, or targeting a path for the price level or nominal GDP rather than for inflation. None of these alternative frameworks are without challenges, but the positive and negative should be thoroughly reviewed to evaluate whether the net benefits of any of the alternatives would outweigh those of the flexible inflation targeting framework currently in use. So 3 years ago at this conference, I discussed the challenges U.S. monetary policymakers faced in preparing for the start of monetary policy normalization. Today, the median run outlook for the U.S. economy is very favorable and policy normalization is underway. While the economic environment has changed, monetary policy challenges remain. And I really appreciate this opportunity to explain how I'm approaching some of the policy issues the FOMC faces. And I'm very much looking forward to taking some questions and hopefully providing some answers. Thank you very much for your attention.
We will have a few minutes for questions for our panelists. Please note the microphone in your chair, and also please identify yourself. Thank you.
President Mester, to what extent do you worry?
Can you introduce
Oh, I'm
yourself?
sorry. I'm Chris Whalen with the GIC. I'm an investment banker in New York. President Mester, to what extent do you worry that the asset purchases, both by the Fed and other central banks, have constrained both short-term and long-term interest rates? In other words, if you were to stop paying interest on excess reserves tomorrow, I have a number of colleagues who trade that market who think the rate would go down quite a lot. So when you talk about that natural rate that we're looking for, how do we get to the point where there's enough demand for short-term funds that we could maintain it without essentially having the Fed pushing the floor up?
So let me see if this is on. Oh, that's pretty easy. Thank you. Thanks, Chris. So yeah, you're exactly right. So one of the goals, as you remember, of buying the assets in the first place was to put downward pressure on the long end of the yield curve. And so part of what's happening, of course, is that pressure is still on because our balance sheet is still very large. We are taking off some of that and normalizing the balance sheet. We're going very slowly and we're going very deliberately, and we're trying to do it in a way that can run in the background as we're moving the target. And you're right, because of the large volume of reserves, we're moving, right, the way we're getting the funds rate to move into the target range is by that interest on excess, paying interest on excess reserves. So those tools go together, right? So you're right, if we woke up tomorrow and decided not to pay, right, you're right, that would change the dynamics in the market. But again, we're using that tool to bring the interest rate, the Fed funds rate, into the target range. But as I also said, there have been changes in the funds market in terms of demand and supply since the Great Recession. And one of the considerations when we're thinking about what framework we want to use in the future are precisely those about the funds rate market, the dynamics in the market, whether that funds rate is going to continue to represent the level of short-term interest rates that we should be targeting. And that's a consideration when we actually decide which framework we're going to use. And there are various arguments on both sides of trying to get back to a small balance sheet type of monetary policy and trying to use a large balance sheet. Different policymakers have different views of it. The Fed has not made a determination yet. But you're exactly right. What happened in the market was precisely because we needed to put downward pressure on the long end of the bond market.
Good morning. This is Ángel Melguizo on the OECD, on working for Latin America. If I have to pick one issue that is different today versus 2 years ago, and that was not very much mentioned, was digital and cryptocurrencies and let's say the new financial intermediaries. I think it was hinted by the governor, maybe in this box that I haven't read. But what's your view, and are you working together somehow to face what's happening outside, because there is like a new financial market in the making, and I would like to hear your views. Thank you.
It's a very important question. It goes beyond monetary policy, obviously, but let me give 2 or 3 comments, and then, Loretta, you will give yours. I think we will also converge on these issues. I was impressed by the convergence on our 2 speeches in the final part about the new operational framework and the new normal. But let me come back to digitalization. First, you mentioned what you call cryptocurrencies. One word about that, which is only a small part of the story and probably not the most important one. We in the G20 in Buenos Aires, so 2 months ago in March, discussed about the issue, and we had very clear conclusions. First, we don't speak about cryptocurrencies, we speak about crypto assets, because we said very clearly that these are assets and very speculative one, and they don't have, I quote the G20 communique, they don't have the key attribute of a sovereign currency. The technology is very promising. The underlying technology, which is blockchain. I say it here in the Banque de France because we were among the first central banks to use blockchain to develop it for one of our ledgers about the SEPA identifier, and it works. And we will go on as the technology. But about crypto assets, we in the FSB looked at the risk and we said first that financial stability risk at present, I stress at present, are rather low due to the volume. But we will continue to monitor financial stability risk. But there are already 2 important challenges, questions. First, anti-money laundering. We all know what happens on the dark web. And second, consumer protection, because these assets are very productive. So we required the FSB, the FATF for anti-money laundering, and the standard standing bodies to study the adequate responses to these 2 challenges. And we will have an important meeting of the G20 in July to study the answers. It will be as multilateral as possible, because it's a global challenge. But some jurisdictions, I think to the state of New York, to Japan, to Korea, possibly to the European Union, already studied and implemented local or regional regulation. So this is for crypto assets. For digitalization as a whole, it clearly changes completely the financial and banking landscape. And when you discuss with banks, let me focus on banks, but I could say the same thing of insurance or even asset managers. But when you discuss with banks, I don't know, Loretta, how it is in the US, I know how it is in Europe. It's very interesting to see what is their main challenge. Some years ago, they would have said very probably it's regulation. It's about Basel III, etc. We had a round table with them in Basel 10 days ago. None of the banks who were in the meetings mentioned Basel III. We found it very interesting and positive, to be frank. A second challenge is usually monetary policy and the low level of interest rates. It still plays a role, but our monetary policy is clearly adequate. We are convinced about that, and we are on the path of a gradual normalization. So more and more digitalization is the challenge for banks and other financial institutions. And they started to adapt, to be frank. It doesn't change the nature of our own job. This is at least my view. But it changes the customer relation for all banks. And it also changes probably the business model for many of them. Because to put it in a nutshell, I'm a bit oversimplistic. You had till now remuneration of banks through interest rate margins and fees. You could have in the future a remuneration of financial services through the use of data. And this is the business model of big techs and some fintechs. So, it's a very exciting story. I don't think it changes the nature of our job as central bankers, but clearly financial institutions have to adapt and for the best of their customers, because it will bring many new services at a lower cost. We should not forget the basics of the business, including cybersecurity, data protection, antitrust, and anti-money laundering. But again, it's a huge opportunity.
So I'm going to say what he said. But same thing in the U.S. Like if you ask bankers now what their thing that keeps them up at night, what they're worried about, it's cybersecurity, hands down. They always mention cybersecurity. So this disruptive technology, they have to worry about their own security. Then they also bring in the regulatory part because of the level playing field. In the U.S., there's different regulations depending on what kind of firm you are. And even though they believe that cybersecurity affects all different types of firms, they feel like some firms get a benefit over other firms. So the regulatory part comes to play in that kind of competitive landscape. But this disruptive technology is changing all industries in some respects. I think I agree with the governor that a central bank's job, the basics remain the same, but I think we also have to keep up in a way, and we need expertise that we probably did not have to have 10 or 15 years ago. And so I think that's a challenge. But the same challenge happened, remember, when we had to learn new ways of modeling financial risks. There was always the idea that, well, you can't really be a regulator and have the same expertise that the banks have, and there was always this kind of competition for talent. I think the same thing will happen on the technology side as well as we go forward, and hopefully we'll be able to hire the right people to help us.
I completely agree. A key principle being, as Loretta mentioned, same activity, same regulation, whatever the nature of the financial actor is. Perhaps a last question. Two last questions, but short one, please.
I'm wondering, with one of the major debtor countries of the Eurozone negotiating a Eurosceptic government, and the German government and advisors considering a new approach to Target 2, if you think the APP approach means that we don't have to worry about a new Euro debt crisis.
This is your comment. It wouldn't be mine to put it in a nutshell. It's not usual for central bankers to comment about domestic political developments in any country, perhaps by exception in my own country, but it would be a cautious exception. So don't expect from me any political comment about some of the member states you alluded to. But we are confident about our capacity to use our instruments in the whole framework I described. So I said some clear red lines we have, including the avoidance of fiscal dominance, and it's important in this context. Fiscal rules apply to all member states, including mine. But having said that, we are confident about our capacity to run this unconventional monetary policy, because I speak also under Loretta's control for the US, but we have run this monetary policy in new political times already. Please.
So, Michaela Markson from Société Générale. I'm curious to hear a little bit about dollar funding. It's recently become a concern in global markets, both in terms of its cost and availability, and both from a cyclical and a structural point of view. And I imagine, Governor, that perhaps it was one of the issues that may have come up in Basel. So I'm curious to hear your thoughts on that, and how you as central bankers take this into consideration in your policy setting.
I was suggesting this was a question for Loretta. I will complete.
Well, I mean, certainly we care about sort of I'm not exactly sure what you're referring to, but we certainly care about stress in financial markets, including how different kinds of markets are functioning, right? And so we take that into account when we're thinking about our monetary policy, but we think of that as different than the settings of where we would put interest rates in order to, hit our dual mandate goals. But in terms of the actual funding of the markets, that would be one of the things that we would care about in the second part where we're talking about what's the best way for us to run monetary policy, what's our framework going to be going forward. So we are very cognizant of stresses in the markets. We routinely review what's happening in markets overseas because they affect U.S. markets as well, and it's a global financial market. But that doesn't necessarily drive where our settings are in terms of monetary policy. I hope that helps.
Just to complete, the short answer to your question is no. We don't worry. We are always vigilant about everything, certainly, but we don't worry in our international meetings. You mentioned Basel or others, and especially for French banks, I don't worry. But we are vigilant about all topics. Okay? I suggest we stop here with the Q&A session, and then I give you the floor back to come to our first panel. Thanking you again, Loretta.
Thank you very much, Governor. Thank you, President Mester, for those insightful comments.